I'd like to discuss common situations all active investors will face. The most common situation that investors must plan for is quarterly earnings reports. There's simply no way around it. If you want to hold a stock for more than 3 months, this is a situation you must prepare for. The truth is, regardless of price action and recent news, we can't know ahead of time if a company is going to have a good or bad earnings report. And what makes it even more difficult is that frequently, guidance is more important than the recently completed quarter. Some people like to hedge with options or sell their stock and wait to re-enter after the report is made public. I don't prefer those choices. In the case of purchasing protection from options, they tend to be extremely expensive. In my opinion, prohibitively so. The idea of selling your stock and buying it back after earnings is also not ideal because the best earnings reports that launch significant stock advances occur with a gap, and you end up paying much higher prices. Also, by selling and rebuying, you create a taxable event, which to some people is not acceptable. The way I approach earnings is I first ask myself if I believe this is a stock that is performing as a leader or has the qualifications to become a prominent leader. If I don't think it is, or I don't think it may become one, I just take my profits. Again, if it's not a leader, you want to sell into strength. You want to harvest some smaller profits. They're going to offset those smaller losers. If I think a stock may become a big winner or is already acting like one, I require a profit cushion of at least 10% if I have a full stock allocation or less. Most growth stocks will gap between 15 to 20% either up or down. If I have a 10% cushion and the stock gaps down 15% against me, it's only a 5% loss on what's at most a 25% allocation of my equity. That amounts to a 1.25% account loss on the trade. And now if the stock gaps down 20%, it's a 2.5% loss on my entire account. I can live with both those scenarios. But if it gaps higher on good numbers, well, now I'm well positioned in what may be a game-changing stock. Sure, a stock can gap down by more than 20%, but we need to take calculated risks. Really, a stock can gap down any day on unexpected news. You have to choose what level of risk you can live with and demand a properly sized cushion before earnings. Now, suppose my stock allocation is greater than a full position due to pyramiding. Well, in that case, I require an even larger cushion because black swan earnings reports will have a much more significant impact on the account. For example, if my position was 50% of my account equity rather than 25%, which is a full position, I wouldn't just double the cushion requirement to 20%. Given the outsized position and the dramatic impact, a big loss would be on a 50% exposure of my account, I would want a much bigger protective cushion. For example, I would want a 30% cushion rather than just a 20% cushion. Another topic that comes up rather often is stock offerings, secondary offerings. Basically, when a company wants to raise money to either further invest in their business or to buy a competitor or to buy some kind of new technology or expand, they will sell shares to the market, and that usually causes a gap down. This is why earnings per share is more important than net income, because as a shareholder, all that matters is what portion of that income comes to you. So if they dilute you by adding more shares into the market, your share of those earnings are going to be much less. That's why a stock always gaps down, because now that income is distributed over more shareholders. Now, unless you own a stock that has triggered some hold rules that is a big winner for you, I think you should take the profit if you have any left after the gap down after the secondary offering. The reason I say that is it often takes weeks for this new supply of stock to be fully absorbed in the market. In the meantime, you're sitting with a stock that's not really moving, you're still exposed to downside moves if the market falls over, and that risk reward is kind of shifted against you. So unless it's something you got a big cushion on and it's a big winner, just sell it, take your profit, step aside. The only time I wouldn't worry about all of this is in the rare case that this happens, but it does happen, is that the terms of the offering are just much better than what the market would have expected, and the stock actually moves up on a secondary offering. That really shows there's a ton of demand for the stock. Look at the bigger picture. If they did an offering, it's not negative just because of the offering. If the market loves the terms or they really buy into the reason for the offering, maybe they love the company that they're buying, or they're very happy about the direction the market's going to take with this new capital from the equity raise, that's a bullish scenario. So you would stay with the stock. Really, it's if it gaps down against you, that's when you want to really reconsider if you want to be in that stock position. Another item that comes up rather frequently is upgrades and downgrades by analysts. Now, not all analysts are created equally. Some upgrades and downgrades have no impact at all on the stock, and others can have a significant impact. But what matters most is really the reaction to the analyst report. And I find it best in general to ignore them and just follow your buy and sell rules. I mean, most reactions are short-term in nature and no actual change has really taken place with the company. So if the stock is gapping down against you and your sell is being triggered, you have to respect that and you want to exit. If this upgrade is viewed very great by the market and we gap higher and the volume is really strong and you're triggering a buy rule, go with your buy rules. Essentially, just use analyst upgrades and downgrades as just another piece of information that the market is absorbing, and don't get overly fixated on whether one analyst likes or dislikes the stock or whether they've changed their price target. Just let the market talk to you and tell you what the market is doing. Another common scenario is initial public offerings, IPOs, and their subsequent lockup expiry. Whenever a company comes to market and issues new stock on the secondary market, there's typically a period of time where insiders can't sell their stock. This gives the market time to settle in and prevents insiders from overwhelming a recent issue. Now, that lockup period usually ranges between 90 to 180 days. So whenever an IPO comes to market, and we discussed this in the hold rules, where if you have an IPO pre-lockup period that advances very quickly, you want to harvest those profits because that lockup expiration usually does put a lot of weight on the stock and usually causes a downward trend. Once that expiry ends, I'd say, really you want to just judge price action as it comes along. If insiders are going to be selling, that's going to show up in your price and volume action and you'll be able to adjust accordingly. Just be aware whenever you're trading around IPOs, you want enough time to pass so you can see proper stock charts form so you can control your risk and you can find proper buy points. But as that expiry is coming around, be aware of what date that is, and typically you want to be out of the stock just prior to that expiry happening. Once the lockup expiry ends, you can basically treat that stock like any other stock in the market. Another situation I want to address is what happens when you mess up a market cycle. Basically, markets move in cycles. They don't go up forever, they don't fall forever, but sometimes you just completely screw it up. So you missed your buy signals or you didn't sell on time. And really, now you're trying to get back into the market, you're chasing it, and that causes more mistakes, and you really want to stay calm and prepare for the next significant opportunity rather than stay locked in a negative spiral as one bad decision leads to another. Again, our goal is long-term success, and I know from experience, the opportunities just keep coming given enough time. Again, the key to success is consistency, discipline, and emotional control. So if you really messed up an uptrend or you got a little bit hit in a downtrend, pause, refocus, wait for your proper setups. They will come back again. Don't force it, don't overdo it, and if you're really off, just take a little bit of time away from the market and come back with some fresh eyes. On that note, let's discuss overtrading. Sometimes you're just trading so much and you're kind of losing the forest for the trees, and when that happens...
Is that the expression? You're losing the... Sorry.
Yeah, okay. On that note, let's discuss overtrading. Sometimes you get so enthralled, so pulled into the market that you lose the forest for the trees and you're just trading way too often. You have too many losers, too many small wins, and you've kind of lost sight of the bigger picture. When that happens to me, I like to take a moment, take a pause, and focus on weekly charts. It cuts out a lot of the noise and really has you focus on the bigger picture of what's going on. Also, you want to avoid buy patterns, buy signals that you don't have written down as part of your plan. It's natural, you probably love to trade as I do, and you read a lot of books, you look at a lot of different strategies, a lot of different tools, YouTube videos. Basically, you're going to read everything you can about the market, and a lot of these different buy techniques are going to seem appealing to you. But if you're using too many techniques, if you don't have it written down as part of your process, then basically at a certain point, everything is going to look like a buy pattern. It's going to draw you into the market way too often, and you're no longer going to be disciplined. So if you like a pattern, take it, make it as part of your plan. But whatever it is, you want to have your plan preset before you approach the market looking for buy patterns to avoid you from just pretty much buying whatever looks good. Also, you may want to tighten the criteria you use for the universe of qualifying stocks that you'll trade with. So if you're taking just way too many trades, we'll cut down the number of stocks that qualify as potential winners. This is going to force you to really look for more quality stocks and to prevent you from just buying any stock that's moving quickly that day or that week. Also remember, keep a 5% distance between your purchases before you add to a winning position. It's possible sometimes that a stock is basing or is in a choppy sideways motion and a bunch of buy signals come up. You could have 2 or 3 buy signals trigger in 1 week and you just keep adding to that same stock, and then a small movement against you can knock you out for a bigger loss. So waiting for that 5% advance shows that the market is providing this profit cushion to you. It's showing that you're right on your initial assumption, and it's going to slow down the number of purchases that you make on one stock. It's also going to keep your excitement about a stock in check. So keep that in mind. Lastly, limit the number of holdings in your portfolio. If you cap the number of holdings you can have, whether it's 8 or 10 or 12, that's automatically going to limit the number of new buys you can go around and chase. So if you're over trading, give yourself a hard limit. Say, I won't go above, for example, 10 stocks in my portfolio. And that's going to help control the amount of trading you do, and it's going to force you to really pay attention to the more quality setups that you're viewing in the market. As you run into situations that surprise you, take note of them. What was the result? Why did the markets react that way to that news announcement or to that change in the market? Create rules and guidelines for when they happen again in the future. With time, you'll keep refining your process, and eventually you'll become a cool and calm investor solely focused on applying your strategy for big profits. Best of luck.